Okay, good afternoon, guys. Welcome to the live trading clinic. My name's Steve Ruffley. Today we're going to focus on the Bank of England, and the rate decision and the asset purchase facility. Like many, many things over the many years we've been doing presentations, I don't think there's going to be that much, obviously, change the interest rate or maybe that much change the asset purchase facility just yet. But these things are coming. As I keep saying, we're shifting cycles now. We're focused much more on the inflationary data and what's going to happen to interest rates than we are with growth. Undoubtedly, there's been more fundamental information, more fundamental shifts in the markets. We've got Greece, we've got China, we've got cyber attacks or non-cyber attacks. We've got plenty of things moving the markets. But in traditional terms, when we're talking about, how the markets ebb and flow, it's between my 80-20 rule, the 80% of technical movements between known support and resistance and trends, and then that 20% of the fundamental data that's shifting the markets. And that would normally being, these big bets, when interest rates are going to rise. We know it's when, it's not if. So the US are going to either move, Q3, Q4, 2015 or early 2016. My money is still on 2015. And that means, the UK are going to follow suit at some point. So today, it's not about if we are unchanged and people go, oh, that's a non-event. It's any comments that come afterwards, any rhetoric. We've seen from the FOMC minutes, previously in previous, ECB statements that these, have the ability to move the markets much more than non-farm payrolls. So anything today could be quite significant to the pound. It's been quite a downward spiral recently. The FTSE again is, like most of the indices, gaining some traction and strong again. I don't think really anyone knows exactly why the market's moving, how they are. If they say they are, they're lying because, I've been doing this as long as, most people I know in this, kind of business, these kind of, modern day trading scenarios, screen trading. And, it's just difficult. It's difficult to know why the markets are moving, what true sentiment is, what people actually, are thinking. So what we'll do is we'll go through my standard presentation fairly quickly. I'll go through the markets. I'll go through, again, what we're going to expect today. And any questions you've got, just ask me as always. So before I start, as always, the risk warning. Remember that spread betting and CFD trading can have high risk or capital resulting losses to exceed your initial deposit. The membership is for everyone, so please ensure you fully understand the risks involved. The information and comments provided here under no circumstances are offer solicitation to invest. Nothing here introduces you investment advice. The information provided believed to be accurate. The data is produced. Again, educational only. The content of the webinar is personal opinion of the moderator, not insurance.com. The content is not constitute financial investment. Insurance.com is not set any liability of the content comments during the session. So we're going to cover live charting analysis. That's how we get our information, really. That 80%, live, markets moving between support and resistance, and all the things we need to look at. Multiple time frame trading, just figuring out what's happened in the past to predict the future. Again, I don't know how any other way there is to trade. Fundamental analysis, that's what we're waiting for in 27 minutes. So any change to this asset purchase facility and the actual core rate itself. Then account's always open. You can see my my screen's in a second. If there's anything good, I will trade it. And your questions, anything you want to ask, again, just ask me. So look at the markets right now. Again, we're seeing the DAX remaining very, very strong, getting to all these upper levels. The FTSE's following suit. If we're going to see a break, I guess, above, 6563, we could easily get to the 6622 mark. Not particularly sure, again, what the good news is in the markets driving it. Maybe it's people getting out of China, putting into European stocks. Maybe it's, who knows, maybe it's this impending doom for Greece is not really ever going to happen. Cyprus is going to push the EU as far as he can and then finally buckle and make a deal. I don't know. It's just so difficult to know why the markets are moving exactly, how they are. But we're still in a very bullish trend. And if you want to figure that out, go to the higher time frames. So again, although we've sold off, quite heavily in the previous month, we're still, the pattern's still up. If you want to draw a trend line, you'd still draw a trend line like this. It's still, we're still fairly bullish. We're still towards the top of the range. And as you cycle through, you can see that, yes, okay, the market's come down to these lows. But, immediately, this week, we bought them all back up. And every time we see the rejection, the market's gone higher. So rejection here, we don't go higher. But if the market starts to close around, these levels around here, around 764, 68, again, we're still very bullish, really, in long terms. We look at the monthly charts, we're nowhere near trading, to these kind of low points. So as markets go down, they rebound upwards. So I would say the weeklies still show that we've got rid of a lot of negative, kind of down movement. If we're going to, be very, very negative and continue a sharp fall down like China's done, then we'd have broke this trend line and used it as resistance and moved further down. So I don't think we're looking particularly strong, but we're not looking particularly weak. We're kind of, just in that wait and see type pattern. Again, the dailies show the same picture. We've moved through this very strong daily trend line that I've shown you before. Then we've kind of consolidated, here, and then the market has come down. So we've hit this very big point of, 3 key levels of support and resistance, and the market's just tested, just dipped back down. So again, it's either going to get back to these levels, close this gap here, or it's going to continue to the trend at 6382, break it, then we're getting down to 6307, 6129. I mean, that's as easy as you can make technical analysis, really. But I would say that while there's still free money in the markets and interest rates are still relatively low, then compared to China, compared to Japan, compared to any kind of Asian market, including Australia and New Zealand in that, then the Europe still seem fairly robust, and so does the UK. So interesting to see what's going to happen, I would say. But right now, again, you're going to be looking to buy any major dips and the low points in the stocks, and every time you do, they reward you. So I think the S&P, is the same. We've seen these big sell-offs, but as big as we sell off, we have them equal bounce backs, and that's just on the hourly charts. The daily's the same. We finally dragged through and broke and gapped down below this big daily trend line. So we're starting a new range here. So the market's going to do one or two things, isn't it? It's going to try and get back up to test this trend line, around about 2104 as support resistance, then close above it and go up, make new highs, or we're going to range sideways and move down to these lower levels, test 2038, again break to 2000 and get down to 19915. Again, market's moving cycles. We go up, we go down, we consolidate. So we have to figure out if the market, is completely done now, if that's as high as we're going to go, in the monthly charts. If that is as high as we're getting now in the S&P, then we move into this trend. It's still an uptrend. So you still, can buy these lows. But if we're going to move sideways and finally break through it, you'd expect the market to exhibit this kind of pattern. So what goes up will come down. I mean, that is just the way markets, move and then the way they kind of behave. So the fact is we're just only breaking through this lower trend. So if you look at Europe, we're much more towards these trend lines. So you could say that Europe might drag the US down. So again, that's another way of looking at it. But again, it depends how you look at the markets. If you're trading short term, long term, what your ideas for the market is. Again, I'd always refer back to the hourlies. Because that trend line's up here. So again, if the markets spike up very quickly, again, I'd be looking to probably sell some highs because we look pretty comfortable selling back down. We look on the potential sell on the kind of indicators here for the market getting to high points and selling. But what you're looking for is the markets to go up in these big hourly green candles, big long bodies, and just try and get the top on the turn and then get some selling action. Or, again, if you want to go with the trend, which I said is still up, buy it to these levels. These levels instead of bounce become break points. So remaining fairly strong in the indices across the board, and it just goes to, I think it's any kind of news to do with Greece, anything to do with Cyprus, making a deal, that problem of contagion goes away, that problem of, that problem of European Union losing its credibility. But does it really? I mean, I think, it's all for the short term. In the longer term, Greece, as Angela Merkel put it, very astutely, it's not about the 1.5 or 2 billion, euros that they owe to the IMF. Not really interested. It's really not a lot of money. It is not a lot of money. It's the problem is they're going to need 40, 50 billion over the next kind of, 6, 12, 18 months to keep the banking system. So it's not about, the tiny amount of money that they may or may not pay back and go into default. It's about what happens afterwards. Where's that money going to come from? Greece is quite a prime example of what happens when you take a lot of money you're not entitled to, by fudging the figures, and then go on a massive spending spree and promise, the boomer generation, they can all retire in the 50s, they can all have ghost jobs, they can all have this great standard of living, and, retire early and not work that hard. And then all of a sudden it all falls apart. You lose 25% of your GDP in 5 years, and you expect the young people of the world to pick up the slack. And young people say, no, I'm not going to do that, thanks. I'm not going to pick up the slack. Why? Why should I? Why should I pick up the slack? I don't have a house. I don't have a job. I don't have security. I don't have any much future. So why should I, say that I've got to work for another 10, 15 years to pay for all the mistakes you've made? So, I mean, that's the kind of moral and social issue that we're getting in Greece. And unfortunately, you can't make Greek people act like Germans. You can't make the Germans act in any other way. And they're the ones with, so they say, the money. So unfortunately, it's not about just the money. It's about Greece doing as they're told and playing ball. And the longer we drag these things out, the more annoyed people are going to get, and the less likely it is that Greece are going to stay in the euro, because they all want to stay in the euro because it's a pain. It's a pain, isn't it? It's a pain to go back to the drachma. It's a lot of uncertainty. But really, what are your options right now? You either do as you're told and you take the money, or you don't take the money and you figure it out on your own. So for me, very, very difficult to see how Greece is going to stay in the eurozone, and that's just from the kind of shifting expectations from people. And people ultimately are going to win this call. It's not about the banks anymore. It's not about the deals or how much money is going to be left over. It's about people saying enough's enough. We're not interested in taking this money anymore. We'll go back to the drachma and we'll take our chances. And that's probably the best thing for Greece to do. I think the European experiment has failed, and it's ended the line. And the contagion, I'm not so sure about. The contagion might come further down the line, but unfortunately, Greece is quite a unique case because it's lost so much of its own, kind of credibility, but also, kind of so much of this GDP. Whereas, other, nations like Spain, Portugal have lost it, but just not to this degree. They still have the high unemployment, but they haven't lost that ability to create some sort of, internal jobs. So I've got a couple of questions coming through. Is China stock decline sending out a warning sign to stocks globally that a downturn could be in the cards? Your view on the stock market, or is it isolated event to China only? Well, I mean, it can't be isolated to China only. I mean, China is the second biggest economy in the world. So when you lose, 1.5 trillion over 3 weeks, that accounts to Greece's GDP for 14 years. Okay, so think about it in those terms. We're all worried about Greece, but China's lost 13, 14 times more than the entire GDP annually of Greece in 3 weeks. So yeah, I would say it's something to be concerned about. The big concern for me about China is it's over 1 billion people. It's still communist, and there's this massive gap between rich and poor. Now, once you start giving people money and you're giving them, that little bit of power, and it might not be power in traditional sense, but power in individual power. People don't like to be told what to do. So how are you going to start to control 1 billion people when they don't want to do as they're told? Okay, that's when China falls apart. It works because lots and lots and lots and lots of poor people do exactly what they're told, make money for the rich people, and everyone's happy with that. But you start losing your life savings, you start to see the mighty, dragon of China, starting to fall apart, then what's going to happen? Lots of money is going to flow out of China, because the rich will always be fine. The rich have, they have money, they have options, they can do things. But I think the world's going through some major shifts now. The big thing is people don't understand the pace of change anymore. They think the stock market's, moving 10-year cycles, 5-year cycles. Maybe they don't anymore. Maybe they move in 18-month cycles, 3-year cycles. All these boomers, all these people that lived through the 60s, 70s, and 80s saw that, appreciation in house prices. Didn't really do a lot for the money. They reckon they worked hard, but they didn't. They just did as they were told. Okay, they just took the jobs that were taken, bought a house because that's what we're told to do, paid the mortgage, and now it's all happy days. But that isn't the same for future generations. They don't have that ability. They have to pay for their education. They start life with debt, and any house they want to buy, they've got to put their own money down first, and if they can afford to buy a house at all, if they get a job. So it's not quite as rosy, is it? I mean, it's kind of all these boomers are going to fade out into, into pasture in the next 20, 30 years. They're all going to be gone. Inheritance tax is going up. So what the government's relying on is that, these people don't blow all the cash, blow all the pensions, they leave it to the kids, so the kids have a start in that way. Because they're just not going to have the same ability to start in the way that other generations have. So I think that's the government's plan. So that's why they're kind of, slapping, students with these, huge student loans and taking all the benefits away. And they're expecting the mum and dads to pick up the slack, and that'll to be paid back by, their great wages. But I mean, when that's going to come, who knows? But the majority of money I would see is going to be coming from inheritance, and that's why we're raising the threshold for inheritance tax at the minute. Because in the next 10, 15, 20 years, there's going to be a lot of release of property, a lot of release of equity, and that's going to filter through the generations. I think that's just the plan. And, you can understand the Tories thinking of that because they're all rich kids, aren't they? They're all from rich families. So why wouldn't they think that everyone else in the situation, these guys are idiots. But that's what you guys voted for. So you get what you voted for, unfortunately. You don't like it, you got to lump it. Euro dollar. Well, euro dollar, again, remains fairly buoyant for, the situation we're in. I mean, again, we're still towards the lower of the range, but after this 9 months of selling, you're always going to find some period of green and some consolidation, just some bargain hunting. So really, we're consolidating around this 1.1 mark. If Greece finally leave the euro, obviously we're going to get below 1.0 and probably down towards these lows. I don't know. For me, not really interested in the euro. I'm kind of just staying away from it. I don't see any real short-term value trades. I mean, if you look through the dailies, again, I'm just really holding around this 50%. So you can make just as much argument for the euro getting back up to these levels of 1.13850. If Greece are going to stay in the eurozone, everything's going to be hunky-dory, or the same argument for it getting down to these lower levels. Down here at 1.08168 and then below. Finally, we're going to get towards, this parity level of 1.0, and then the real fun and games start. But still looks a downward trend to me. We're still, downwards, a downward channel. So we're either going to reject this low of the channel here and then break up, and everything's going to be fine. People start buying the euro because, again, seen a lot of dollar slide, haven't we, in the last kind of few weeks. So maybe people will come back. But I think the underlying kind of tone is that all these games that Greece are playing just make the eurozone day by day look more of a joke, look weaker and weaker. If you can't control somebody's 1.8% of your GDP, what's going to happen if somebody bigger wants to, push you and renegotiate? At the end of the day, you can't take all the money, you can't spend all the money, and then agree to pay it back on your terms. You just can't. And I don't care if it's fair. I don't care if people are suffering. I don't care if it's, I don't care. I'm talking as an investor here. I'm talking to somebody who's trying to make money at the market. I don't care about Greece's situation. I don't have any sympathy for Greece, okay? All I want to know, are you going to pay the money and do as you're told, or you're not? I'm going to keep this dragging through. So that's what you've got to think as an investor. It's not about emotions. It's not about feeling sorry for Greece, It's about understanding, what are they going to do? Are they going to play ball or not? So for me, I would say that probably I'd be more inclined to be selling the euro, based on the fundamentals, based on my opinion of Greece, based on my, interpretation of comments I've heard. Everyone's getting sick of Greece, and I think it's a power play for Greece to eventually leave. I think that's been the plan all along. Go back to the drachma, experience a couple of years of pain, but get back to growth on your terms. All these, kind of penalties and all these things that, the European Union are putting on Greece, put tax up on the island. Well, with the euro, it's still expensive anyway. So you start putting, tax on people that come to Greece, then Greece is going to be even more expensive. And if you're trying to make your money from tourism, then it's just not going to work. If you go back to the drachma, and everything's, cut in half and everything's cheap as chips to buy, people will flock back because people have no loyalty. Look what happened to Spain. Look what happened to Turkey. All these things move in cycles. People went to Turkey, people stopped. People are now going back to Turkey. People went to Greece, stopped. Now they'll come back if it's cheap. Look at Spain, look at the Canaries, anywhere. But if you have control over your own currency, then, you have control over your own destiny. So under the euro, things remain expensive, taxes go up, okay? GDP continues to go down, people struggle. So I cannot see a way of Greece finding a way with the European Union to stay in. So I would say that the euro is under threat, and these lower levels are where we're going to hit. So gold's another one of interest, even with all this kind of stock market strength and all this fear in the markets. We've still remained, fairly negative in gold. Again, I've shown you time and time again this this Fibonacci. I just cannot see how gold is going to stay high. From the lows here in 08, the lows here in 08 to the highs up here. And we've used that 50% as an absolute, point of attraction, haven't we? Look at that. Beautiful. So now we've on a downward slope. The market's rejected it a couple of times, but here, If we start to close below this lower fib here where we're trading now at 168, then we can only really get to $1,000. There's nothing really left, is there? So below that. So again, break through that $1,000, and that'll be my prediction from 2013 in the Financial Times. I said that would happen by 2015. So still on track. So very interesting. So gold, as kind of cycle through lower high, lower high, lower high in the weeklies. Dailies, same scenario. So sell every high in gold. It looks like it's going to $1,000. So again, all the uncertainty in the world is not pushing gold back up. So what can we do? We can only sell highs. There's no all these dreams of gold getting back to 1900 and all these kind of things I've been told by other so-called experts just don't seem to be coming true. There's no physical shortage of gold. The majority of gold now, because it is cheap, is going into Indian women's jewelry boxes. People with different cultures. It's not going into bank vaults, and it's not going into big, hedge funds and portfolios. So who's gonna put it back up? Okay, 1 second. Let me just. I hate it when I do that. Okay, dollar yen. Again, same scenario. We've kind of taken a little bit of a hit because we're really on some technical selling points for the dollar here. But we're still very, very high in the range. If you look, gapped here, went to this very, very strong support point at 100 spot 82, and then all we've done is gone from higher. So monthly, yeah, okay, we sold off a little bit towards the top. But you expect a lot more selling with such high, kind of monthly pushing, kind of technicals pushing it down. We can still get to 135 and above. Yeah, but again, we're still high in the range. So it's natural profit taking. If you look at the weeklies, 1, 2, 3, 4, 5, 6 weeks of selling, but it's not been anything dramatic, has it? It hasn't been, anywhere near, the size of selling candles that we see of buying candles. So I'd say that really, until we get back to these levels here, at 118 spot 833, then the market can still very easily come down. But I expect to consolidate and to move slower towards these points, and then the dollar to bounce back up. The dollar's still going to be the first currency to have an interest rate hike, so people are still going to buy the dollar. You've seen all these problems in Japan with them selling of bonds. I think they've sold 4 trillion worth of bonds over the last 3 months, something ridiculous. So people are getting frightened about the situation in Japan, and certainly the situation in China is not going to help. So dailies, probably yesterday we saw that big sell-off. When we look at the double bottom towards these levels, we're expecting this to be a good buy. Okay, so good buy. The market's bounced back from these lows. We're trading, quite significantly higher. So even do yourself a Fibonacci. Yeah, so we're trading right back to the 50% of yesterday's down movement. So rather going to find support on that 50% and go back up, or resistance, the market's going to continue this down move. So again, these are your boundaries, back up to the highs here, at 1.25, or, we're going to get back down to the lows here where the market found at 118, spot 490. So really, we're in this kind of downward range, I would say. Again, if you want to see, a little bit further back, where the 50% is, time and time again, look at 50%, how it acted as support resistance. And we closed below it, below the 61.8. So rather back to the lows here, as I said, or we hold above the 61.8, go back to the 50, and go on to make a new high. So we don't really know. It looks more bearish in the short term than bullish, but really, again, if you look, this is only the last kind of, few weeks of trading. If you look back to the weeklies, we're still very, very high in the range. So I wouldn't expect a major correction in the dollar just yet. I'd expect some profit taking towards the top of the range. But I would say with the problems in the emerging markets and the Eastern markets, full stop, then the US is probably a safer bet than most. So I'll be buying any major dips in the dollar yen. That's for sure. So any other questions, guys? Any other thoughts? We've got the Bank of England today. We're expecting the asset purchase facility to remain unchanged at 375 billion. We're expecting interest rates to remain unchanged at 0.5. It's not about the actual figures today. Again, it's more about the rhetoric, any comments. You've seen the Greece kind of, not problem, but the kind of ripple through from Greece, has already made, people start talking about the US maybe might leave interest rates for now, and, we're relying on the US for, the global economy growth. I think we have to understand that this is what we don't get as a society. That it's not always about growth. Sometimes about quality of life as well. Just having more people making more money and spending more money doesn't necessarily mean it's a good thing. It's about quality of life for people that live. It wants to be a wage slave, working to pay some ridiculous mortgage off just to keep up with the Joneses. You know what I mean? It's people are gonna change their opinions. I mean, the up and coming youth, the people of the next, 10, 20 years, the next couple of generations, just won't have the same expectations. So naturally, things will shift. People might think to themselves, what's the point in owning a house? I don't want to own a house. So they won't. But then that, again, is not necessarily a good thing because that's how we've built our traditional values that if you pay your taxes, you buy a house, you're a good little boy or girl, then you get to make some money in the world and you get to have a pat on the back. But maybe people don't expect that anymore. We don't have that. Then what happens to the world? Again, that fear, that contagion. People getting worried about, what they've got, and people not sharing their views, and that's why we have this radicalism in Islam, and we have these problems with different religions. They just don't have our Western thinking. So how can we make them, like us? Well, we can't. So there we go. Dollar Swiss. I'll have a look at dollar Swiss. Um, dollar Swiss. Yeah, big spike in the dollar Swiss. Again, I mean, I think the Swiss are under, increasing pressures. They're removing the peg from the euro and all the things they've done. I mean, really, well, how are we trading? Well, we're trading kind of, I would say, yeah, slightly more on the bullish term, really. We've kind of, rejected here, this big kind of sell-off opportunity. We've kind of consolidated now. So, yeah, I'd expect these highs to be tested, potentially, in the market to move back up through the weeklies. Just a mini fib on that. Yeah, looking bullish for me, to be honest. So what you were saying, sell around, good to sell around 95. I'd probably say no. I'd probably say it's a buy, to be honest. I mean, I'm still fairly bullish the dollar in general. So I'd expect now on the weeklies, we've held above this 50%. I expect it to go higher, to be honest. And then dailies, again, not much above to catch it. So I'd probably say you could sell it, but I mean, don't start selling it until 96. I think this region here, it looks good for a break. But I mean, that's just my opinion. I mean, what do I know? I mean, they look pretty strong on the smaller time frames, the 4 hourly, and then the hourly. So yeah, potentially I would say that. Again, it depends, but I would say for me, all the fibs you do were above the 50%, and you do like this final fib from here to here. Until we get down to that 50% here, we're not really going to know. So 94.98 is like a pivot point intraday. So if we sell all the way back down to here, then see what happens. Maybe then we find support, we go back up, or if we are going to sell off from that point, then yeah, it's a good point to pivot and come down. So that's my kind of view on that. All right, guys. Well, 2 minutes to the data now. So we're expecting, no change in the core interest rate at 0.5. We're expecting asset purchase buyback to be 375 billion unchanged. Okay. So we're not looking for any kind of major shock in the data today. What we're waiting for is any comments that come out, any way the markets might move in an not in an unpredicted manner, but, something that just kind of makes us think that, people are making an opinion. I mean, we have moved down and rejected in this hourly candle here. But I mean, we're only talking, relatively small moves, kind of, 36 and a half ticks or so. But, still towards the high in the DAX, in the FTSE, SMI's come down a little bit. Gold, again, gold is just such a tricky one to trade at the minute. It really is one to be wary of. It's moving in the same direction of the indices, for the majority of the time, indices go up, gold should come down. It's really not. So quite difficult. Let's keep one eye on the FTSE. Let's keep one eye on the pound versus the dollar. Let's see exactly what happens. Again, obviously, if anything is unchanged, we're going to see massive movement. Sorry, if anything is changed, we're going to see massive movement. But we're expecting unchanged here. So let's wait for the data to come across the wires now, guys. 10 seconds. Unchanged. Unchanged. So unchanged are both. Unchanged in interest rates, 375 billion unchanged. So we just saw a little bit of a downtick in the pound against the dollar on that unchanged data. So as expected, unchanged. So no real change in the FTSE. FTSE still towards the top of the range. One, two, three, four, five. Five green candles. Quite high on the kind of time for a correction or some profit taking. So look a little bit weak in the pound here on the back of that data. Again, we saw that rejection. So this low point here, a good level at 1.53620 could be the target to break. And then we got down to 1.535 and 1.5315. Hmm. Okay, so just a couple of comments coming over the wires, but nothing really related to the UK, to be honest. I mean, again, you'll get to one of these sessions, guys, and then we will see change eventually. We're so kind of short-minded in of our kind of, fundamental outlook. Back in the day, all we focused on was interest rates, and cuts and hikes. But now, it's all growth. But we're going to get back to that point. We're going to get interest rate cut and hike, and we're going to see massive moves in the markets. Again, it's just because we've artificially held interest rates so low. And that's all because of these quantitative easing measures, and this kind of ultra low rates are going to stimulate growth, and they have. But from the consumers and from debt, it's like we've learned no lessons from the previous credit crunch. So still looking fairly bullish in the indices. The DAX is looking to make a new high here. So I think this is a good level up here. 11010 spot 88. So I guess, guys, yes, a bit of not a non-event, I guess, but yes, inline data is not really changing much in what we're trying to achieve here from the UK market. So it looks like the trend's going to continue. So the trend, is bullish in the indices, and it still looks fairly negative in the pound against the dollar. So dollars, again, still looking a little bit weak. So again, it's trying to tie up all these correlations, isn't it? It's never easy. But as the dollar gains strength, yeah, you expect that the pound to come down. The euro, it's the same kind of correlation. You're always looking for these correlations between gold, the dollar, the euro dollar, the pound dollar, and the dollar yen. These are the kind of correlations I'm constantly checking to see if I can get an edge. So any final questions or any final thoughts about the markets? I mean, I would say looking through the calendar, we've got initial jobless, which could be interesting. 130 continuing jobless claims again could be interesting. Apart from that, got the Fed's George speaking tonight at 6 o'clock. Don't think that'll be of much particular interest. Then moving through tomorrow, we've really only got Canadian data that might be of any real punch, or Janet Yellen speaking at 5 o'clock. Apart from that, we're pretty quiet from data. So you'd expect with my 80-20 rule that we just kind of ebb and flow now between the trends. So I think the trend is we've generally opened low in the mornings. We've then gone higher. We've sold off towards the US Open, and then we've continued the trend. So that's what it seems to be. So I'd look for selling opportunities towards the US Open in the indices, the DAX and the FTSE, maybe the SMI, and then for them to continue to chip up if we hear no particularly negative news out of Greece. And that's really, if you look at intraday charts, all they've been doing, for the last 6 weeks. So it's just finding them trends and just replicating them, isn't it, guys? Yeah, I mean, good question. When you look at so many charts, how do you use which is a leading indicator? I mean, it changes. So, like I said, I mean, for a long time, as gold was getting more expensive, as the dollar was getting more expensive, going up, you see gold come down, and sometimes that, was a leading indicator. But then other times, you see the indices moving up and gold moving up. So you have to understand that negative correlation doesn't exist anymore. So, what we're trying to do now, is figure out what the trend is, and the trend is that really nothing's following anything particularly. And what the trend is for me is every time we see a downward gap in the indices, they get bought back up. Every time we see a low point in the indices, they get bought back up. So that's what I'm looking at. As I said, gold was the trend that every high point it sold down. So I see gold particularly high, I might sell it. But it doesn't necessarily tie in well if the indices are high that gold's a good sell, or the dollar yen's high that gold's a good sell. So it's figuring out, what I mean. This for me is a snapshot of the world. I've got the Swiss safe haven. I've got the DAX bailing out, Europe. I've got gold, a traditional safe haven, okay, but big figure trader. I've got the UK market, so I know what the UK is doing. Then I've got the US market, which drives the world. Then I've got the pound, okay, against the dollar, which is, the FTSE versus the S&P in some respects. Then you've got the dollar versus Japanese yen. So the dollar, strongest currency in the world, arguably, versus Asian markets. Then the dollar versus yen. So I've got a good snapshot of what's happening in Europe, America, and for me, this is the only kind of real indicator I use of what's happening in the in the kind of far Eastern Asian markets. And that's how I view the world. I view the world through charts. So this continues to be strong. You expect Europe and the UK to be strong, yeah, and gold maybe to hit tops and come down. But again, it all depends what cycle we're in. Yeah, I mean, these indicators are my software I view charts. This is how I view the market. So it basically all my technical studies, all my thoughts, all the way I trade the markets, all my technical indicators, everything's in my book that's coming out next month is in my charts. So I apply it to markets automatically. So I don't have to keep looking for correlations. It does it for me and it changes with the market conditions. All right, guys, anything final before we wrap it up? As I say, I would expect the trend to continue into the US Open, and then maybe look, for the markets then to sell off, take some profit, and then the trend continue. That's really what's been happening over the last 6 weeks. All right, guys. With nothing else, I think for the Bank of England, that's been it for me. I would look for these low points in the pound. It seems to be looking, quite likely to sell off, and again, any strength in the euro, I would not really be kind of buying the euro. But again, you might see some spikes, some relief buying based upon, the Greece is going to finally play ball. But you just don't know with Greece. I mean, they've not really kind of kept to their promises so far, have they? And even with Varoufakis gone, I still think Greece, has lost. Well, even if it had any credibility, it has no friends in Europe anymore. All right, guys. Well, been an absolute pleasure. Anything else you want to know, get me on Twitter at Steve Ruffley. Okay, guys. Take it easy. Have a good afternoon. Thank you.